Are you tired of high volatility in the markets? Even though markets are highly volatile, do you want your investments to react lower? Do you want to pay a lower expense ratio? If yes, you are watching the right video. Hi everyone, welcome to Bytes. In today's video, we will learn an important strategy on investing and a new fund offer which looks attractive for investors during a high volatile environment. Disclaimer, this is not a buying or selling recommendation. I am just presenting the facts and data which are available in the market. Use this information as a part of your research and then take a suitable decision. Topics we'll be discussing in today's video are factor investing, low volatility factor and its performance with historical data, NFO and its details. Let's get into today's video. Factor investing. Before understanding what factor investing is, we will understand the meaning of term factor in investing. A factor is any characteristic that helps us in explaining the long-term risk and return performance of an asset. In simple terms, we can say a factor as a particular parameter that helps us in understanding how an asset performs in the long term with respect to its risk-reward ratio. Some of the commonly known factors are low volatility, momentum, quality, value. These factors are the building blocks in every investing process. We can say that any investor or any fundamental stock picks are mostly evaluated through one or the other factors as mentioned above. Hence, we call these factors as the building blocks in the investing process. Now, what is factor investing? Factor investing is an investment approach that involves targeting specific drivers of return across asset classes. The specific drivers of return are nothing but the factors such as quality, low volatility, momentum, etc. We all know market works in cycles, trends and themes, meaning sometimes there will be high growth factors in the economy due to which high growth stocks start moving based on momentum. Similarly, during a recession period, the growth reduces and mostly quality stocks start coming into the limelight. So there is no one particular factor which can last forever in our markets. But remember, market rewards all kinds of investors provided one has patience and time. Hence, we need to do some research on constituting our own portfolios based on macroeconomics condition and have a proper asset allocation plan for our portfolio. Just to show you a brief performance on how these factors have performed, check the chart. We have considered returns based on 4 factors: low volatility, momentum, quality, value, along with Nifty 200 index. If we consider the performance of the last 3 years, in 2019, momentum has delivered a highest return of 10.6%. In 2020, low volatility has delivered a highest return of 26.8%. In 2021, value has delivered a highest return of 56.9%. Overall, we can say that no single factor has outperformed consistently. But adding these factors in our portfolio will help us in improving our risk-adjusted returns. Let's also check how these factors perform during various market cycles. In a bull market phase, low volatility index has given decent returns of 28.9%. But we all know that during a bull market phase, high growth momentum stocks will be highly benefited, and this can be seen in the chart. In bear market phase, low volatility has given a minimum downside of negative 25.6%, and during the recovery phase, it has delivered a return of 37.8%. So overall, we can say that the low volatility index has delivered a good risk-adjusted return. In this video, our major focus is on the low volatility factor. So we shall dig deeper into this particular factor. Do comment below if you want detailed videos on other factors as well. A low volatility strategy involves buying stocks which have higher stability in price movements. Commonly used descriptors to identify low volatility stocks are beta and standard deviation. Why does low volatility strategy work? There are three significant reasons why this strategy works. Number one, overconfidence. Investors are generally overconfident in their ability to forecast the future of companies with more uncertain outcomes. Hence, they end up purchasing mostly high volatile stocks. Number two, asymmetric returns. Low volatility strategies tends to fall less in market downturns, which more than compensates for modest underperformance during rising markets over the long term. In most of the markets, retail investors enter into a stock at higher valuation, and when there are market downturns, these stocks will have maximum drawdowns resulting in asymmetric returns. Number 3. Lottery effect. Investors tend to overpay for high volatility stocks in the hope of turning it into a multi-bagger, while they tend to underpay for low volatility stock. This psychology of people will help us in getting a low volatility stock at an attractive or cheaper valuations. By now, most of you would have guessed about the fund's objective or strategy of investing. The NFO is Motilal Oswal S&P BSE Low Volatility Index Fund or ETF. So they are releasing both mutual fund as well as ETF. As the name suggests, the fund focuses on investing into S&P BSE Low Volatility Index. This is a passive mutual fund where expense ratio is also low compared to actively managed mutual funds. What is the methodology of selection of stocks in this index? Low Volatility Index picks companies from S&P BSE Large Mid Cap Index. It picks 30 best companies based on the volatility score. Some of the parameters they consider to determine the volatility score are beta, standard deviation, etc. Maximum weightage is capped at 5% for each of the stocks, meaning for any stock they cannot invest more than 5% of their asset under management of that particular fund. Also, index will be rebalanced every March and September. To understand the concept of rebalancing, watch the video in the I button. By now, if you liked our efforts in this video, hit the like button and share this video to your friends and family members who are looking to invest or already investing in the stock markets. Let's pull out some charts to understand S&P BSE Low Volatility Index historical performance. Last 15 years historical performance between S&P BSE Low Volatility Index and S&P BSE Large Mid Cap Index can be seen in this chart. From the graph, the yellow line indicates S&P BSE Low Volatility Index performance. We can see that this index has significantly outperformed over the long term. Calendar year returns. When we compare the returns of each calendar year, S&P BSE Low Volatility Index has outperformed 9 times out of last 15 years. Even during the drawdown periods, the drawdown of S&P BSE Low Volatility Index is significantly lower. Performance during crisis. When we look into the performance during the global crisis, S&P BSE Low Volatility Index has outperformed S&P BSE Large Mid Cap Index. In the year 2008, during the global financial crisis, S&P BSE Low Volatility Index had a drawdown of negative 32%, whereas S&P BSE Large Mid Cap Index had a drawdown of negative 43.1%. The difference between two indices was 11.1%. Similarly, during the US taper tantrum, China yuan devaluation and COVID-19 pandemic, the drawdown of this index is much lower. Smaller underperformance during recovery phase. In this chart, we can see the returns during the recovery phase as and when the crisis was stable or over. Almost in all the recovery phase, it has underperformed but not to a greater extent. Yes, this is a minor drawback, but when we compare to the risk-adjusted return, I won't consider this as a drawback. One thing for sure in the market is no one can time the markets exactly. Only thing we can aim for is a decent risk-reward ratio, meaning for any risk we are taking in the markets, it should yield us a higher return. Over the long time, if we check out S&P BSE Low Volatility Index, has delivered good risk-adjusted returns. This statement can be proved using this chart. This shows us that this index tends to fall less during a crisis, which more than compensates for relative underperformance during the recovery phase after these events. Many of you might have curiosity on how this index perform with respect to our Nifty 50 index. If we see the CAGR in shorter time frame, which is less than 3 years, Nifty 50 tend to outperform this index. But simultaneously, we should check the annualized volatility, which is higher in case of Nifty 50 index when compared with S&P BSE low volatility index. But over the long term, S&P BSE low volatility index has managed to deliver higher CAGR returns with low volatility, which is a very positive sign. Let's check how a SIP investing would have performed in this index. A SIP of 10,000 monthly for 10 years would result in an accumulated principal of 12 lakhs. Towards the end of 12 years, the market value of the fund would be approximately 28.4 lakhs. So let's answer a most important question: who should invest in this fund? Always remember, there is no one single magical formula in investing or trading. We should always be diversified, but not over diversified, as it can lead to reduced potential returns. Who can invest in this fund? A person who is worried about market volatility can consider major allocation into this fund. A person with an aggressive portfolio style can allocate some funds to reduce his overall portfolio volatility. One who has a long-term vision and is new to capital markets can certainly allocate major chunk of his money into this fund. Also, during the bear phase or any global crisis scenario, you can tend to invest some part here, as the drawdowns are a bit lesser compared to Nifty 50. If you don't want to pay a higher expense ratio, this fund is very much suitable for you because they are offering index fund and ETF whose expense ratio is significantly lower when compared to actively managed mutual funds. As you know, in investing, there won't be any strategy with only positives. Every strategy which we follow has its own pros and cons. So, what are the cons or limitations of this fund? Number 1, market cycles. Low volatility factor performs differently in different market cycles, making it important to understand its cyclical nature. Number 2, high churning. Churning is a process where some of the stocks or assets will move out of a portfolio and new set of stocks or assets will be added to that portfolio. This is done based on various parameters, investing styles, etc. Frequent churning incurs some additional expenses because of frequently buying or selling of assets. For indices based on the volatility factor, the churn is generally very high, approximately 50%, compared to a broad-based index like Nifty 500. Let's wrap up this video by checking into NFO details. Firstly, let's check the details on ETF. This is an open-ended fund replicating S&P BSE low volatility index. Minimum amount during NFO is Rs 500 and in multiples of Rs 1 thereafter. Indicative expense ratio is 0.35%. There is no exit load for this ETF. NFO period has already started and ends on 16th March 2022. Other details of the ETF can be seen in the screen. Let's have a look on Index Mutual Fund. This is an open-ended fund replicating S&P BSE low volatility index. Minimum amount during NFO for SIP and lump sum is Rs 100 and in multiples of Rs 1 thereafter. Indicative expense ratio for regular scheme is 1% and for direct scheme is 0.4%. Exit load is 1% if redeemed on or before 15 days from the date of allotment. NFO period has already started and ends on 16 March 2022. Other details of the index fund can be seen in the screen. If you have any questions regarding the fund or anything related to investing, do comment below. I will read everyone's comment personally and try to answer as soon as possible. If you like the efforts put into this video, hit the like button. If you are visiting our channel for the first time, subscribe to our channel and press the all notification bell icon to not to miss any future videos. Thank you and have a great weekend. Bye.